Let's do this. We are going to have a conversation about saving money today because I feel like that a lot of people are coming to me about saving money, what it looks like, what is a fantastic way to be able to start any kind of savings fund that you may be looking at. I personally don't believe in savings. I don't believe in the savings accounts that are in the bank. Why? Why don't we use savings accounts that are in the banks? Well, that's because we know all about fractional lending, and that means that they are using our money to do with it what they want to do with it in lending it out. So why would we put anything in something as volatile as a bank to save our money? That's what we want to talk about. A lot of you guys have been asking me too about the IBC. What is the IBC? How does it work? Why do I do the infinite banking? So that's what I want to talk about here for just a few minutes to give you some ideas on what to do with that money. If you have a money that is sitting available, even let's say that you want to start doing some kind of investing after you've used velocity banking and you've gotten your debt under control. I started working with the IBC when I wasn't quite out of debt. I wasn't quite out of debt when I started my first one. But you have to realize that if you're going to somebody that your brother-in-law Bob, and he's an insurance agent, and you say, hey, I would really like to set up one of those, um, infinite banking policies. And they're like, yeah, let me set you up an IUL. Well, you know that brother-in-law Bob has no idea what he's talking about. So you want to get educated before you start jumping into any sort of infinite banking concept policies, okay? It's super important that we understand there is a difference with these specialized policies. So we're going to talk about saving money in the IBC. What is the IBC? Well, it's the infinite banking concept. So for you guys who have no idea what I'm talking about, this is probably as you probably have never heard of this. So this is probably as different of a concept as the velocity banking was to you when you first heard about it. Now, the IBC, let's talk about what it offers when it comes to your money and why is it that I, Christy VANN, would use IBC instead of investing into the stock market, for example. Okay. This is a deep conversation for people because we're just assuming that we know what to do with the savings because why? Because why? Let's talk about it. Why do we get loans? Why do we take loans? Well, that's what we were taught to do. That's just what we do, right? So, why would we listen to anything that somebody has told us in the financial world about where to save our money? Why? Because that's just what we've been trained to do, okay? So, super important that you understand that everything has an outside of the box thinking to it, right? We're not into the system, we're thinking outside of the system. What can we do that is really good for our money? How can we use our money more than once, more than twice? I know that's a very foreign concept, but it works. And that's why I teach a foreign concept to American finance, is because there are different options that you didn't know about. So it's super important that you really listen up here and you really learn from the channels that are trying to teach you a better way financially, because there is a better way. So okay, so I have people all the time all the time, every call nearly. Hey, I have some savings in the bank. What would you do with it? Well, I used to say, well, if you have debt, then let's see if your savings is drawing as much interest in your savings as you're paying out in debt. Okay, so this is simple, guys. So hold on. If I have $5,000 in savings, okay, and it's sitting here, and then I have a credit card number one that has a $2,500 balance on it, and I'm paying $200 a month, and it's at 25%. And then I have credit card number two, and it has $750 on it, and I'm paying $50 a month, and it's 29.99%. And then I have credit card number three, and it has $1,000 balance on it. I pay $100 a month, and then let's say it's got a 21% interest rate. So if I have this debt over here, I always look at that debt compared to the savings, and then we talk. So if I have somebody that comes to me and they've got credit card debt, so this is 2,500, 750, and 1,000. So 4,250 is the amount of debt they have. They're paying $350 a month in payments, and then their interest. So if you were with me last night, you watched how we calculate the interest on these credit cards. So for 2,500 times 25% divided by 12, it tells me that they are paying $52 per month approximately in interest on this one card. Okay. And then for the 750 at 29.99%, they're paying $18.74 in interest per month. And then the 1,000 at 21%, $17.50 in interest per month. Okay, so $4,250. They're paying out 52 on one, 1750 on the other, and 1874 on the last one, which means they're paying interest of about $89 per month. So my question is if you have savings sitting in the bank over here, and then you have debt that's gaining $89 per month in interest, when you ask the question, what should I do with my savings? You might want to ask yourself, is my savings gaining $89 per month in interest every month? Is it gaining 89? If it is, then you're breaking even, okay? Because you're paying it out over here, but you're gaining it over here. But what if you're doing if you got this in a savings account at the bank, you might be drawing 0.0125%. The banks don't pay much when you have savings sitting in their savings account, do they? So if you think you're saving money, but yet you're paying interest, you're losing. This isn't a positive. You're losing $89 a month, even though you don't see it coming off of your savings balance. You're paying it out of your income into here. So totally, common sense says, well, I would want to pay off my debt, but there may be a better way. That's where the infinite banking concept comes into play. So let's watch this for a second. Now, I love the IBC because I just think it's a glorified savings account that I absolutely love. Whereas the IBC is really just a whole life policy that's specially designed for you to kind of make money while you're using money. Let's see what I mean by that. So let's say that I have $5,000 in savings and I still have that credit card debt I just talked about here. But I take $5,000 and I put it into an IBC whole life policy. What does this mean? This was so stupid to me when I first started. This was so stupid when I heard this because I don't like paying car insurance. I don't like having to pay for health insurance. I don't like having to pay for life insurance. I feel like that, you know, by the time you do your E&O insurance and then you're covering your home insurance, it just seems like it's a blow, right? It just seems like it's another way for the companies to make money. But the whole life that I learned about with the IBC makes me want to run around the room in excitement because of this. If I take 5,000 and I set a premium up to where I'm paying $5,000 in, they will work that out according to what kind of scenario you have going on in your own life situation. So you would have to have a conversation. I'll give you some information for that later if you want to. But when the 5,000 goes into this whole life, what happens to it? Well, sit down because you're not going to believe this, but this starts growing at compound interest. Okay. Okay, so that's pretty exciting. Compound interest, that's pretty exciting. This also pays dividends. Now, they're not guaranteed, but the companies that I have been paying out dividends for 100 years or more. So I'm enjoying the benefits. So you've got compound interest, pays dividends, and it's guaranteed. What does that mean? Is your money guaranteed when it's sitting in the bank? I don't think so. Guaranteed. Now, what do I look for when I'm looking for somewhere to put my savings? Well, I like to look at guaranteed growth. Guaranteed growth. Do you have guaranteed growth in your stock fund right now? Guaranteed growth. Why is it guaranteed growth? Well, because of this compound interest. So it's compounding. It's beautiful. Guaranteed growth. But what's better for me? What's better for me than the guaranteed growth is this one. Guaranteed not to lose it. Do you know how when you're a broke person and you're living paycheck to paycheck most of your life, that when you think about putting into the stock market or something, you know that feeling that comes over you like, but what if I put this in there and the stock market falls and then I lose all my money? Real scenarios every day, right? Very big risk, very big risk. So if you put your money into guaranteed growth, guaranteed not to lose it, that right there sold me. I'm like, let's do it. Oh, but wait a minute. I don't want it to be like a 401k to where I can't touch it until I'm 59 and a half. So do I have to wait until I'm 59 and a half before I can use this? Nope. What can we do? We can take loans from this. This is our money that goes in. This is our premium money. With this premium, not only comes guaranteed growth, guaranteed not to lose it, but it comes with a death benefit, just like you know a whole life to do. So guess what? My kids are now covered. Anything happens to me, they're good to go. Right? That's a very good feeling for a parent. So guaranteed growth, guaranteed not to lose it, and you get the death benefit. Okay. What else do we have here? We can use it. So we can take a loan from ourselves. Now, when I heard that, I took a step back. And I literally had a conversation. Why would you take a loan from this? Well, a couple of things. Go with me here. You're not going to believe this because it took me a long time to get all of this in order where I could feel it and believe it myself. So I'm with you, okay? I had to walk all of this out. And I'm kind of letting you jump light years ahead by bringing it to you in layman's terms so that you can kind of understand what I'm talking about here. You'll still need to study this. But when you take a loan, you're taking it from the insurance company. Okay, now go with me because you know I'm always saying I don't like loans. Loans are a ripoff. You know I say this. Now you're hearing me use the word loan, but I'm getting ready to flip it around, okay? I'm getting ready to flip it around because I thought it was a loan too that we took from the insurance company on our own money here, whatever you put in. Dudes, it's a line of credit. I know, because I said to Chris Noggle one day, I said, okay, if I take a loan, and let's say I take $4,000 from this account, and I have it transferred into my checking account at my bank. When I take the $4,000, if this death benefit is $100,000, and I take $4,000, I do not have to pay that back. I don't have to pay that back. Unbelievable, right? Well, hold on. Because, well, why don't I have to pay it back? Well, because they're going to deduct the $4,000 off of my benefit that my beneficiaries get. So they would get $96,000 instead of $100,000.